As we begin to look forward to the fourth quarter of 2022, investors continue to face the fallout from an unprecedented rise in inflation, and it's broadly keeping the lid on risk assets. Is there anywhere to hide or indeed to benefit from what's going on at the moment in the markets? Welcome to this edition of IG Trade in the Markets podcast. I'm Jeremy Naylor. We're talking today to Robert Alster, Chief Investment Officer at Close Brothers Asset Management. Robert, good to talk to you. Thanks indeed for joining us again on the podcast. At the start of the year, you and I spoke about 2022. And of course, in that early part of the year, we hadn't really got any clue as to what was going to happen between Ukraine and Russia. But at that point, you had nonetheless warned that it may be a tough first half of 2022. But with developments now moving into the sort of area they have moved into, with Russia and Ukraine and a race away inflation, how do you see the fourth quarter developing?
Yes, the fourth quarter is going to be very difficult. We've seen from the third quarter corporate earnings season that was surprisingly resilient and strong, but it's clear that the effects of inflation, whether it's energy or food prices on the consumer, the crushing of their disposable income is going to feed through to demand for all a raft of companies that we can go into, whether it's hospitality or industrial companies, and that's going to affect employment prospects. So I'm afraid looking into the fourth quarter, it's very much going to be a downward slide. And I guess the question becomes is just to what extent that's going to be. And of course, on the other side of the coin, what are the central banks and authorities going to react?
That's the question about how long is a bit of string, isn't it? I mean, does anybody know where the end game is? I guess not. And we've just seen a relatively strong print on US inflation, suggesting the Fed is going to keep up its pressure on interest rates across the pond. We are fairly confident at this point that the Bank of England is going to act again next week when it meets again on its delayed meeting. How do you feel as an investment manager about talking to clients about what you're doing at Close Brothers and how you're arranging assets to park themselves in a way to either protect assets or in some places possibly also take advantage of an opportunity?
Yes, you're right. I guess the thing to talk to clients about is clearly assets are being correlated. We've had equities and fixed income declining at the same time, which in the past has been relatively rare. You know, you normally have bonds and fixed income in your portfolio as ballast, as a counter to what may have, and be less risky than the equity portion. And of course, that's what's different this time round. So it's been very, very hard. And year to date, if you look across asset classes, they're virtually all down, bar rather ironically in some ways, the UK equity market, which has been buoyed up by energy, material stocks, and of course, the decline in sterling. So other than that, it's that plus commodities and some alternatives, which no doubt we'll come on to, have been the only up asset classes. So talking to clients, first of all, in a wealth manager, it's about the long-term view. It is about opportunities from here. So it's very much a focus on, well, when does the Fed, the Bank of England, when does the path of interest rates peak and start declining? And that's when equities as an inflation hedge and as future growth, that's when they become interesting. So you're right, out of every crisis is born opportunity. And the thing is not to crystallize a loss, hold your nerve and look for those opportunities coming out of this fourth quarter and into 2023.
Yeah, that brings in the psychology of investing, doesn't it? I don't really want to move into that necessarily, but I know that we all should be aware of the fact that you're right. Only losses are only if take effect when, as you say, they're sold into. Let's go back to this length of piece of string and ask you what you see as the catalyst that you're looking out for to indicate to you that interest rates are either no longer going to go up or at least not go up by the sort of speed with which they've gone so far in the last 4 or 5 months or so. What do you see as the points of interest to watch out for?
Mm. Yeah, good point. I think the answer is that all eyes are on the US and the Federal Reserve. They're leading this cycle in terms of interest rates going up, and they've made it very, very clear that they are going to they are going to increase rates until there are signs that inflation are coming off, even if that means affecting negatively the US economy, either through unemployment or corporate bankruptcies. Inflation is their number one aim. So, we take the Fed at their word. They're dependent on the data, so are we. So we watch to see what point that the Fed accept that inflation is on a definite downward trend. One swallow doesn't make a summer, so you can't just wait for the odd sort of moderate inflation number. You need a downward trend. You need it heading back to 2%, and it's somewhere along that path. Do you think, right, this is it? This is the point to move up the equity weighting? But we're not there today, that's for sure.
Yeah. The other thing is, many of us have turned to debt to paper over some of the cracks, as the FT says today in an article it's published about the exposure that some companies have got that have high debt levels. I mean, whether it's the government level as well as corporate debts, of course, but at the consumer level, many people having taken on debts, and of course now we're faced with higher mortgage payments for those of us that do have debts to service. How does this affect the investment environment?
You do have to stay clear of companies which have, as you put it, sort of papered over the cracks and are carrying debt, or in some sense were bailed out and buoyed up through the pandemic and the furlough payments. These environments, when economies slow and interest rates rise, really do expose those companies, and that's where you do your research. Essentially, you have to filter those out and think, well, those companies may be ticking over today, but what about 3 or 6 months? If their markets and their revenues slow, their interest payments go up, their earnings numbers are going to be cut. So they're the companies to stay away from. And you have to rethink and revise your sort of business models about the sort of investments you want to make, which clearly would be those with stronger balance sheets, the ability to pass on pricing, for example, to counter the cost increases they're all seeing. So it's a shift really in mindset and an awareness that the sort of share prices you're looking at today can go lower and may well do if the economy weakens substantially. If, for example, it's a lot worse on the downside than we're all forecasting at the present.
That sounds very negative. Our conversation has been about the negative so far, but just on this point, do you see new lower lows for the major benchmarks this year? When talking about higher interest rates, quite often we see those indices with a lot of tech exposure take the brunt of the sell-off. I know in London we haven't done quite so badly as some of the other markets because of the makeup of the FTSE 100 particularly, but maybe we should be looking at the tech stocks. But do you see new lower lows this year, bearing in mind what we've been talking about?
I think the answer to that is a lot depends to some extent on the new prime minister, the package that's been put in place in terms of the energy price cap. We haven't yet got the details of how what's going to happen with industry or the size of it. It's difficult. I'd say the risks are on the downside, put it that way. So given that we're sort of neutral underweight equities, I guess the answer is yes, we are waiting for new lower lows. As an opportunity though, then as I said earlier, to start thinking about what to buy to take advantage of the recovery. That's the way we're thinking of Q4 and into 2023.
Yeah, I'd like to talk a little bit more about the Truss government's energy policy in just a couple of moments' time, if
Mm.
I can. But I'd like to pick up more on this point about how we should be invested. If the downside is likely to persist, as we suggest may be the case, where should investors be positioned for the best returns when the recovery does happen, as indeed we have faith that it will, because equity markets do, on the long run, tend to outperform other asset classes, as we very well know. It's just a question of waiting for that turnaround and having the stomach to go with it. So, where do you see as the likely places for best returns when we come out of this mess?
Mm. Well, we always start off by saying, you've got to have a diversified portfolio. It's never as simple as a bet on one thing or another. So you should always be diversified. And as markets have been falling, the alternatives areas, so sort of mix of equity and project type companies which invest in, well, renewables, for example, solar panels, wind turbines, that area has been benefiting from the power prices and is less correlated to equities. So that's one area to be invested in that's been doing well, as have, commodity related companies for obvious reasons. They're benefiting from very elevated commodity prices. But there will come, as you're alluding to, a turning point in the equity market. And yes, you're right. The tech companies have fallen, and that's because their earnings are far out into the future. They're growth companies, and interest rates tend to affect companies' share prices of companies like that by a great deal more. But on the turning point, that's also, what's fallen the most can often be the ones that do come back and rebound. And they're the sorts of companies, the tech companies, and certain of the higher quality hospitality companies that have been crushed during this downturn because of the consumer worries. That at some point will reverse. It's like everything in investment. It is a question of timing, but they're just some of the areas that we'd look at. And another area actually that's been very interesting is corporate bonds. Because at the moment, some of those corporate bonds have been yielding equity-like returns, 6, 7, 8%. And so that's also an area where you can go into. Now, it's not enough for a whole portfolio, and diversification still stands as well. And on the diversification point, as well as assets, of course, you can diversify through geography. And the US, if it's the first out of this, will be obviously a place to look at and move up in terms of the equity curve for the US as well. And then perhaps you think UK, Europe later.
Yeah. In the interim, before the downturn bottoms out, if you like, and we see significant evidence to suggest that it is over. In the interim, is there an inflation hedge investors could work with?
Yeah, I mean, the traditional inflation hedges have been equities and sort of real assets like commodities and alternatives. So that they are the natural areas to go to. I mean, you can have index-linked bonds as well, but it's quite a small esoteric subset. So yeah, it's again, I'm afraid it is equities, commodities, and alternatives rather than leaving very high cash balances, which, as you and I know, are being eroded at the moment at something like 10%.
Let's clear up on a couple of threads that we've sort of left hanging during the interview, and return, if I can, to the discussion around the trust government, the energy policy, and indeed the renewables. Because to a degree, I suspect let's hope that renewables are part of this energy plan. What are you hoping to hear from this new government to give us something to bite on as investors?
Hmm. I think the energy price cap was necessary. I think we were facing, the largest crunch on consumer disposable income. Would take us back to something like I think we looked at the early 80s. And so I think something obviously had to be done, whether it's economically or politically, and that's now been put in place for 2 years and will obviously lower the headline rate of inflation. There's a serious cost to that. I mean, twice what we put in place for the furlough scheme during COVID. But you buy 2 years and you work out a fiscal policy in terms of the extra debt that you've taken on. I guess the missing element at the moment is this 6 months respite for industry and how that's going to look. And 6 months is a bit of a blink of an eye. So we really would like to see something put in place that protects industry. And you're going to come back to the beginning of this conversation about, well, what about those sort of half zombie companies that were kept afloat? Well, I'm afraid that may be a price you have to pay to get through the next 1 to 2 years. And so that will ameliorate GDP, and that will affect the market's view that interest rates probably won't have to be so high and may come down sooner. So a lot of moving parts start changing when the government's policy is finally fleshed out.
Mm.
So that will help. Investors have some guidelines. It removes uncertainty, and as we all know, markets hate uncertainty. So all of a sudden, you're on a very different path here. So, for example, those Bank of England very pessimistic forecasts of about a month or 2 months ago, they'd have to be rewritten under this scenario.
Mm. Okay. Let's bring it all together and talk a little bit more about the fourth quarter and the further on outlook. So you're saying you still got to batten down the hatches for the fourth quarter. 2023. Is there anything in 2023 apart from the idea that in the longer term you're going to get maybe the comparables which might start to help see inflation numbers begin to pull back a little bit? What are you looking at in 2023? Is there anything significant we should be aware of looking into the new year, or is it just a question of more of the same until we hear more from either central banks or evidence to suggest that we're over the worst?
Well, I think you've hit the nail on the head. It is about those inflation numbers anniversarying through. It is about we've seen today, the UK inflation number sort of go up and core, but headline ameliorate. So it's more prints like that. It's basically a sign that we're quite close to peak inflation and the path is down. And so it'll still be positive, but the rate of change won't be as high. So the numbers will start coming down towards that magic target of 2%. And I think that's what we expect in 2023. But at the same time, I'm afraid I think the economy will be deteriorating, and so eyes will be fixed on what's happening in the labor market, just how many corporates are laying off workers, etc., to what extent. So that's the sort of path into 2023. In the US, I think all of that may play out sooner. And in Europe, I think obviously we're all eyes are going to be on that winter. I mean, you talk about 2023, but the first few months of that, it's going to be a question of, are there going to be power cuts if the winter's very severe, it doesn't rain and the wind doesn't blow, in which case GDP for continental Europe will be cut further in terms of forecasts. So they could have quite a rough time in the first half of 2023, which again will mean that interest rates don't go up and the markets may look at that and try and balance out. Well, which is when's the time to see the equity market rally? When can it see through these difficulties to a time when there's lower inflation and perhaps growth coming through, say end of the first half of 2023. And also, we mustn't forget the largest economy in the world, China, because in October they're having their People's Congress. There may be an end to the zero COVID policy, and China may start accelerating its growth again and trying to move through COVID, which of course will help the rest of the world. Continental Europe has a large exposure to China. So there's quite a lot of green shoots or hope to look forward to through 2023. I think we're having this conversation at sort of one of the worst periods or just through the worst. And it's those sorts of metrics and economic indicators we'll be looking at to determine how to position ourselves for our clients.
Okay, Robert, look, thanks indeed. Here's to green shoots. It's very kind. Thanks indeed for your time. That's Robert Alster, Chief Investment Officer at Close Brothers Asset Management.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.